Welcome to the show. I'm Andy Hagans. Joining us again today is Robin Winkle. And if you missed part one of our interview, see the previous episode that we just published where we talked a lot about macro and just the industry as a whole outlook for oil and gas over the next 10, 20, 30 years. Robin, welcome back to the show.
Well, thank you, Andy. It's great to be back.
But we were getting into a little bit at the end of the last episode. I want to dive a little deeper now. You gave us your insights into the outlook for oil and gas and really how the industry works in terms of scale, capitalizing different projects, and some of these smaller operators in the United States. When I say smaller, not talking about Shell or Chevron,
Mhm.
talking about independent companies that are doing deals in the 15, 30, 100, $200 million range. And you made the point that some of these smaller operators in the States, at least, they're finding it harder to get capital right now. Could we talk a little bit more about that? Where were they getting capital previously? 20 years ago, if I was a smaller operator kind of in that range, where would I turn to for capital?
So if you go back to the sort of 2010s, there was a lot of private equity money flowing into the industry. And if you look at all of the really big PE firms, I think, Blackstone, KKR, these kind of people, they all had funds which invested in oil and gas. And their main funds also invested in oil and gas. And what happened as we went through the 2010s was that the shale revolution, progressed and U.S. production soared, and those companies lost an enormous amount of money because it's one of these things. Like I talked in the last episode about how technical the industry is. One of the things that I've heard from some people in that space is there's always something they didn't tell us, right? So it looks good. We go in, we develop the field, and for some reason or other, it didn't quite work out the way we expected. And so the private equity industry lost, even setting aside ESG concerns, it lost a tremendous amount of money in that period, to the extent which I think it was largely soured on the industry. And I think at that same time, you could say the same for public markets. The industry did not perform very well. And so, you've got two things. You've got the fact the industry isn't very profitable, or hasn't been very profitable in the last decade. And you also have the kind of the concerns about the energy transition and declining demand and the stigma of ESG at the same time. So I think those things have kind of really conspired to kind of throttle the cash flow from private markets.
And so those sources, I mean, those are larger private equity players, right? When you mentioned like a
Yeah.
KKR, and were they generally, funding their own deals internally, or were there funds where they were raising money from other institutional investors or other sources of private
So
money?
so the really big companies would typically raise a dedicated oil and gas fund,
Mhm.
and they would also participate from their main funds. And so you were talking about, $1 billion+ available to invest before debt. So, there was a lot of money available to buy, to buy into the right things, and that led to a kind of gold rush mentality, if you like, in the space. So I actually looked at some valuations that were based on buying a property, so leasing a property, developing it, producing the oil, and then selling it for more than you paid for it in the first place. And that was how you generated returns. And if you think about an extractive industry, that isn't really the way it works because the thing that gave it value is gone. We've sold it.
Mm.
But the mentality was what we do is we buy in, we prove it up, and we flip it. And so there was a lot of this kind of cycling of acreage during that period. People really just trying to get to the point where they'd sort of proven it was good and exiting and getting paid to exit.
So then rather than being a commodity producer, it's more my company buys and acquires land, and then we do geology, right? We we do science
Yeah,
and
it's a promoter model. Yeah.
yeah, okay.
I mean, if you look at the book, one of the case studies that I use is BHP's acquisition of Petrohawk. you can kind of take that all the way through because they got, I think it was $14 billion they spent getting in. And that lost money really from day one. And the reason I was able to include it in the book is that's, they carved it out in their public listings as a separate unit. So you can actually follow the cash flows of that unit. And yeah, I mean, a lot of people were doing at the time what BHP did, and a lot of people lost a lot of money doing it. So yeah.
Understood. And now, the other way to look at, the flip side of what you mentioned, the sort of the exploration and proving it out and then flipping it is, every asset is producing stream of income, right? And depending on the price of the commodity, it might be substantially profitable.
Yeah.
And so what I'm seeing in the marketplace now is asset managers who've been involved sometimes in other areas of alternative investments like multifamily real estate, other sectors of commercial real estate. They're starting to move in more into oil and gas, and usually they're partnering with someone with that experience track record. Yeah. And sort of it's sort of marrying the operational expertise and track record on the one hand with this other skill set, which is we have a network of high net worth investors and family offices. We basically have private capital, and the capital is looking for a place to go because, depending on the sector of the real estate market, the returns right now, prospective returns, maybe don't look so great. And so increasingly we're seeing private funds, private offerings, maybe raising 30 million, 50 million, 100 million, numbers in that range to buy up a diversified pool of assets, whether it's a little bit of exploration or maybe some infield type drilling, or even just buying existing cash flow assets. But a lot of these LPs, a lot of these investors, they're used to the real estate world. They're not necessarily well-versed in oil and gas. And so, Robin, I wanted to cover a little bit of that ground. Just if you're a family office, if you're, let's say, an ultra wealthy, high net worth private investor, you own some real estate assets, and you're going to get your feet wet with oil and gas. What do you need to know? What are some considerations where this is different that you need to be prepared for?
Okay. So I think it maybe goes back to the risks you're taking. So you're familiar with tornado charts?
A little bit, sure.
A little bit. So basically what you have is a chart that shows you how variance in one parameter impacts the return on the investment. And so if you do a tornado chart for an oil and gas asset, the top is almost always price. So that's almost always the biggest impact. And really,
because it's a commodity, right? There's not a lot to differentiate my oil from your oil, provided that it is meeting some sort of standard.
So basically you'll have a kind of a premium or a deduct depending on the quality. And there's really nothing else you can do. You'll have transportation costs. So if you are located near the point where your buyer is located, you may make something there. But generally speaking, no. I mean, it's a commodity. And so that's a risk they're going to take, really, no matter what you do. You can look at hedging if you have enough production. So if your production is spread over a large number of wells, if you have a lot of volume, you could look at hedging a portion of your production. But again, that also has risks, because if you hedge if you read things incorrectly and hedge at a lower price, you actually give up quite a lot of value. So,
it increases your cost structure to hedge, right?
It increases your cost structure, and you also, you give up quite a lot of upside, which is probably one of the things you were looking for when you went into this in the first place. So,
right.
So there are ways to do it, but it's not a silver bullet. And so the simplest thing to do is to buy production, because you're taking price risk and you're taking the least amount of technical risk, or the amount of technical risk which is easiest to kind of to get your hands around. And so that takes the least work, is the simplest thing to understand. The other thing I would flag to your investors, and I would say, I mean, I'm certainly not a lawyer. I'm not a financial advisor. I'm certainly not a lawyer, is to have an attorney who really understands the industry go through your deal structure. to understand, exactly what tax benefits you will and won't see, because the structure of the deal can impact that. So you really have to have some professional advice there.
Totally. And whether your investment, you're classified as an LP or a GP, obviously that can have major consequences. A lot of other details that are very important. And to your point on due diligence, and I think LPs are used to doing due diligence on a real estate deal. Your point, possibly even more important in oil and gas. I mean, do you think that malfeasance maybe is more common in oil and gas than it is with, let's say, real estate syndications?
Well, I think there's a lot of things that can, there's a saying that if you ask two petroleum engineers, you'll get three answers, right? So there is legitimately a broad range of potential outcomes, even for a producing well. You can have well failure, you can have early water breakthrough, there are all kinds of things that can happen. So I think I wouldn't say there's necessarily more malfeasance, but there's certainly more space to have a different outcome than you would have in real estate. And because of the way things are structured with, an owner promoting an interest, so they'll typically have you fund the work and they'll retain an overriding royalty interest in any profitable production. There is less incentive for them to spend a lot of time and money doing that due diligence themselves, because you're the one who's really taking the risk. They've already taken the risk. They've already leased the acreage. So, for them, it's really all upside. So I think you certainly do need to be more careful. So, if you think about any oil and gas development, you've got price and then you have volume. So how do you determine how much is actually there, right? And because this stuff is obviously thousands of feet underground, there's no real way to map it or see it. So you just kind of like, you're trying to bound how much you think is there. How much are you going to get out and how quickly are you going to get it out? Because you want to have production, but you also want to have a quick return on cash flow. So you need a lot of early production. One of the things shale is very good at is actually early production. And then, what kind of technical risks are you taking? So, you know, can whoever's drilling the wells really execute them? Can whoever's operating the wells really operate them? Do you have sort of environmental risks associated with, degradation around the well? Abandonment. What kind of abandonment costs you're looking at? So there's a lot of things you really have to think about in quite a lot of detail that, coming from a real estate background, you might not be so familiar with. So yes, you probably need to be a bit more cautious.
Yeah, and to your point, I do think one similarity with real estate is you want to look at track record, right? I mean, that's
Uh-huh.
that's one way to evaluate an asset manager is simply, have they done it before? How many times have they done it before? And in under what market conditions? How many, in real estate we would say how many complete market cycles? What does a complete market cycle look like with with oil and gas, right? It's so volatile. I mean, just that in and of itself is a bit of a change.
Yeah, I mean, ultimately, that might be the best way for an investor to look at it, to think, okay, what's who is the management team here? What's their track record? And does their strategy fit with what I'm looking for? Are they into existing production? Do they want to do some development? Is it existing production with infill? Is it in an area they've worked in the past, or are they going somewhere new? So those kind of things would probably be, unless you have a background in the industry, probably as much as you could reasonably ask, and understand the kind of answers you were getting.
So, when we're looking at a pro forma, whether it's you, for in your consultancy, or a family office, a high net worth investor looking at a deal, what sort of price for a barrel of oil do you like to see modeled out in a pro forma? I mean, usually you have kind of an optimistic scenario, a middle of the road scenario, and then that conservative or more bearish scenario. What kind of assumptions do you personally even use when
Yeah.
you're evaluating that sort of a pro forma?
So, I mean, I think in terms of mid, you want to look for a historic mid.
Mhm.
And the reason I'm a little cautious to throw out a number these days is there's so much we've had a lot of inflation.
Yeah.
So my numbers probably need to go and be revised. But historically, if you're thinking 60, $65 a barrel, that's typically the kind of middle of the road number that you would see. And then if you think about low side, I mean, there's a point at which the industry can't survive, right?
Right.
So when you see prices drop to a level where, you hear a lot of people talking about bankruptcy and, you hear wails of pain from Saudi Arabia and places like this, that's probably a good low case because it can't really be sustained for long at that level. So, historically, maybe 30 to $40 a barrel is that sort of that real agony point for the industry where, they really just can't survive.
So, and Robin, it's like below that point, it's almost self-correcting, right? Because if it goes south of 40 for any length of time, there's going to be less investment, there's going to be less
Yeah,
production, there's going to be less supply, which will in turn then cause the price to rise.
exactly, exactly. That's the kind of bottom of the cycle sort of number. So nowadays, if you look at the Baker Hughes rig count, for example, you'll see that happen in real time almost. So the rig count's dropped about 100 rigs over the last 6 or 8 months, just as a result of prices coming off from last year's peak. And now, as prices are heading up back towards the 90s, the rig count is again picking up. So you really do see that happen, almost in real time. In terms of the high end, we have seen $100+ a barrel of oil, but once you get up into the 80s and 90s, people are they become unwilling to transact above that level. There's a sort of roof to what people are willing to pay for. And so at that point, if you're at $100 a barrel, you will have a hard time selling your property on $100 a barrel basis. Yeah. So that's the 80 to 90 is probably what I would think of as being the sort of the upper end. So that's the kind of ballpark I tend to think of things in.
So I understand in terms of M&A, in terms of
Yeah.
divestiture, it's going to be hard to, flip an asset where you've modeled, 110, 120, dollar barrel of oil indefinitely. Um, but how much does the asset price really track the price of oil, right? Because I'm thinking surely the price of oil is a lot more volatile than the price of the asset, right? Because the asset buyers and sellers, like surely they're both a bit reasonable about it, right? And understanding that the price of oil tends to stay in a long run range.
Yeah. I mean, it's true, Andy. So what would tend to happen is that you're sitting on your asset and it's $100 a barrel. And you kind of, you forecast your cash flow and you go, this is fantastic. But for whatever reason, I've decided I want to retire or I want to get in a different business or whatever. So you try and sell your asset with that $100 a barrel cash flow. You'll find that most people coming in are not willing to pay for it. So your choice is basically, well, I can basically take a haircut on what I think I'm going to make going forward, or I can just stay in the business. So what tends to happen when you have those very high oil prices is you don't really get a lot of movement because people tend to kind of hang on to what they have.
They anchor it with that
Yeah.
range. Is there a range, or in terms of a multiple or sort of a standard, like in real estate, there's a cap rate.
Yeah.
And of course, it depends on the type of asset and, class A versus class B versus class
Yeah.
C. But in general, oil and gas assets are trading at pretty cheap multiples
They
relative to
are. Yeah.
other types of assets, right?
Well, so publicly they are, yes. In the private markets, if you're looking to buy, particularly production, because that is the kind of easiest thing to model out, there's not really a multiple because it'll depend on what that production profile looks like.
Hmm.
So you would actually model out that profile, and then you would look at, well, what am I going to discount that profile by, right? So, that again depends, yeah. So, but it
And
depends on
and
the
and Robin, I mean, I should mention that's probably what your consultancy exists for, right? Is
yeah.
because every asset is unique, and you do need an expert to come in, model it out, and evaluate it based on many different aspects of it.
Yeah, that is true. Yes, it is different from. I mean, even if you think about, for example, buying a small business, Typically, it's 4 times EBITDA or something like that. You don't really have that kind of multiple available in the industry. It just doesn't really it doesn't really work that way.
Hmm. Okay, so that makes it, I might almost call it asymmetry in the sense that those in the know who are very, very experienced are going to have the leverage, right? Whether they're buyers or sellers, you have to be armed with very good information and context to complete a successful transaction, right?
Yeah, and this goes back to the point we talked about with there's a sort of minimum level at which it's worth bringing that expertise into play, if you like, just because of the cost of doing it. And again, that's what makes it very difficult for an individual to sort of invest independently, uh, really understanding what they're doing, unless they have that background.
Robin, do you think that, you mentioned there's this lack of capital, with these smaller uh, operators, some of these larger corporations have done a bit of an about face. Is there anything that could really, kind of scramble the board here? Is there anything that could, be more of a seismic shift? Like what if oil, gets to $100 a barrel and stays there for a year or two? Would that change the landscape? Is there anything that would really change the capital landscape in this sector that you can think of?
So you could have, um, you could perhaps. So yeah, we talked in the last podcast about the outlook. So the outlook can go both ways. The IEA, EIA, and OPEC are all going to revise their long-term outlooks next month. And so if you see the outlook falling, that would obviously tend to make it less likely people will come into the space. Conversely, if we've gone for so long, and these scenarios where we see a prolonged demand decline are just at the point where they're really no longer credible. That people do acknowledge, okay, there may be a transition, but it's going to be slower. Yeah, I think you might see people coming back into the space. $100 a barrel oil, $110 a barrel oil, 120. That's definitely going to attract interest, just because the way the industry works, there's very little variable cost. It's almost all fixed. So as your revenue goes up, it basically falls all the way to the bottom line, and your sort of profitability explodes. In bad times, of course, your profitability collapses. That's the difficulty with it. But yes, I think a sustained period and a little bit of time. I mean, if you look at the last cycle, that was sort of 86 to 98. So that was sort of what, 12 years. So here we've been sort of 2014, 12 years would be sort of 2026. So yes, maybe just a bit more time and some higher prices, maybe a recognition the transition isn't going as quickly. On the extreme end, you have maybe a terrorist attack in Saudi Arabia, for example, which would really, I think, panic people a lot, because all of the spare capacity in the world now really is in Saudi Arabia, and anything that were to impair their ability to produce would be it would be traumatic for the markets. You would see prices spiking, definitely.
Whether we're talking from the institutional perspective or from private capital, the fact that, oil's at a 10-month high, does that make it a worse time to invest? Like, in other words, are assets just trading at more of a premium right now? I mean, paradoxically, as an investor, bad news is good news and good news is bad news,
Yeah.
and how it affects asset prices, right?
I mean, one of the things I think about price is it's going to go up and down. I think you have to just try and ignore it. So when you're looking at an asset, yes, understand how it's going to perform if it's very low and how it's going to perform if it's very high. But apart from that, because of the cycle time in the industry, you really just need to kind of keep going.
Time in the market rather than timing the market, right?
Yeah.
Absolutely.
So
Well,
decide what you want to do and pursue that.
we're almost out of time, Robin, but do you have any trends, I hate to say predictions because I know none of us has a crystal ball, but is there anything you're seeing in this landscape, especially, where you are in Texas in the United States, that you think maybe doesn't get enough attention
Yeah.
that's occurring in the industry right now?
I think one of the things that we're going to see increasingly is that this is now, I mean, we talk about the narrative. If you imagine that you are a kid in high school who's good at maths and physics, this probably is not an industry you're thinking of going into today. Just because, you're talking about the outlook. I have to say, I mean, if someone in that position came to me and said, Robin, would you recommend I go and study petroleum engineering? I would say, honestly, no. I mean, a high school graduate today is probably looking at a 40 or 50-year career, which would take you out to 2070. And I have absolutely no idea what the world's going to look like in 2070, but I would not be confident there will be high oil demand in 2070. I mean, you have to think by then that all of the money that's going into batteries and that kind of technology will have kind of improved things to the point where at some point, yes, oil demand does decline. But what that
It
means,
doesn't go away. It declines, right? It's not ever
but
going to go away completely.
it probably won't go away completely because you have a big petrochemicals industry. But yeah, you will see those declines. And so I would certainly say, I would not recommend a person coming out of high school does that. But what that means is the industry does not have people coming into it because people have already, they didn't have to take my advice. They've already read the papers and decided that's not the future I want. I'm going to go and do something else. And so the industry is kind of getting starved of kind of new talent, if you like. And this is not the first time that's happened. It was the same in the 80s. So that cycle seems to be repeating itself. And that's one of the things that makes it increasingly different or difficult for the US industry, particularly in the US, to sustain itself.
That's very interesting. And again, it's one of those, I don't want to say it's a self-correcting problem because I don't know that it is, but it's a bit of a paradox, right? Because fewer people that enter the industry, then that creates the shortage, which then ironically makes it more attractive to work in the industry, right? Because then you have leverage as an employee, as a
Yeah.
talent.
Yeah, I mean, the industry is it is certainly cyclical, and yes, I mean, when there is demand there, um, because of because the kind of compensation of the individual is very small in comparison to the size of the investment. Yeah, it does tend to pay quite well. So, but I I think one of the things you also need to recognize when you go into it is it is a speciality. It's not something that it's easy to sort of go and jump into something else, unless of course you do something like finance or law or HR. If you're actually in that sort of petroleum engineering or geology setting, that's sort of really that's really your space. And I think
Interesting.
if you look at the university programs around the country now, there are very few of them left teaching petroleum engineering. So it's something that I think demand has declined very dramatically for. And many young people today, of course, they look at the industry and they don't want to work in it. They see it as being polluting and so on. So they've taken that decision aside from the sort of personal economics of it.
Understood. Yeah, I do think there's a subset, maybe people like me, we have the contrarian bent, when
Mhm.
when I hear something like that, I kind of wonder, and really I think maybe you could call it a gambler or a trader or maybe I wouldn't use the word investor, but in finance, when everyone lines up on one side of a trade, that's usually the bad side of a trade, right? So I think I respect what you're saying, but at the same time, I think there's value in being the contrarian sometimes, where we have all of these assumptions, whether as a society or in the asset management sector. Um, there's always a risk in going against the grain, but a lot of times that risk reward profile can look pretty good, right?
Yeah, I mean, I think certainly the people who were looking to buy oil when it was minus $30 a barrel, I'm sure did very well. Yes. Yeah.
Well, I
Yeah.
think that's a
Good point.
yeah, that's a good note to end on, Rob. And I know we're out of time here, but that being said, where can our audience of high net worth investors, family offices, and industry professionals go to learn more about Glenloch Energy?
So you can go to my website. It's https glenlochenergy.com, or you can call me. I'm available, and you can find the number on the site. So
Absolutely. We'll be sure to
Brilliant.
link to Glenloch Energy, that website, as well as Robin's LinkedIn profile and everything on our show notes, which are always available at wealthchannel.com. Robin, thanks again for joining the show today.
Thank you very much, Andy. Thanks for having me.